Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Sumaira Abdi and Pavitra Parekh. And this is the big day after, right? The FOMC minutes, the outcome is done. It's known. It's another 75 basis points rate hike. And we've been talking a lot about it. But just a quick check on the markets then. The first dip in the market was bought, but then the rally was sold into. So as we speak, the key indices are down close to about 0.5%. The banks are underperforming. The Nifty Bank is down close to about nearly 1% as we speak. But in context to the rest of the Asian markets, where the likes of Hang Seng is down close to about 2%, the Taiwanese markets is down more than 1%. The cuts are not bad. And plus, the Indian markets on a year-to-date basis is still holding on to some gains, slim gains of about 1%, but the rest of the Asian markets have been struggling with cuts going as deep as about 20%. So there is that outperformance, but the big event at least is now out of the way.
Oh, absolutely. The big event is done. But, this morning has already been quite shaky, right? We saw around 100-point recovery from the lows. We again dipped, pretty much gave up all of those gains, and we're back at those low points currently. So that's what's happening in our own markets. But yes, like Reema pointed out, it's still a significant outperformance to what's going down in the rest of the Asian markets, where Hang Seng is down so sharply. The Nikkei market's also under pressure. What's holding up today in our markets, once again, is the consumption pact. This is what we saw yesterday as well. So the likes of HUL, Britannia, Nestle, all holding up quite well. Some of the auto stocks as well as the auto ancillary companies doing quite well. So the ancillaries will also come up for you. The likes of Omax Auto, Uno Minda, all of these holding up well. And, on the downside, we have the entire HDFC group of stocks. So do keep those on your radar. The banks, like Reema pointed out, Reliance is also exerting some pressure. And some of the tech names, because that looks quite divided. So you have Infosys, which did hit a 52-week low earlier today. It's a little bit off that level right now, but that's what's really going on with the markets. Sumaira, quite mixed, but still a lot better than the rest of the world right now.
All right, so let's get started and tell you what all we have for you on the show. Markets are volatile after a weak start as global equities sell off after the U.S. Fed pledges to hike rates until inflation is brought under control. Frontline indices move off, opening lows led by metals and the auto pack. Very small chances of a soft landing, says JP Morgan's chairman and CEO Jamie Dimon, as he hints at the possibility of a hard or mild recession. Excerpts from our exclusive chat coming up in just a bit.
We will also be joined by Jyotivardhan Jaipuria, founder and managing director of Valentis Advisors, to discuss the market fundamentals in the top sectors you can bet on.
As demand concerns rise for the IT sector, we get you an analysis of what companies have to say on the FY23 outlook. And today, the focus is on TCS, a complete explainer on our brand new series coming up on the show.
And the rupee opens at record low of 80.28 to the dollar. Where is the rupee headed from here? We have a complete explainer lined up for you later on the show. So catch all of this and lots more over the next 60 minutes.
So let's start Trading Hour today with a very special conversation. JP Morgan Chase's chairman CEO Jamie Dimon spoke to Shireen Bhan on the global economic outlook, the look ahead for India, global equity markets, Bitcoin, the fintech space, and much more. Listen in to that special conversation.
I think those storm clouds that hit, you mentioned them. Like there's a lot of turbulence out there. And I was never trying to predict a hurricane. I was simply trying to explain to people that it could be a very modest storm, like it could dissipate quickly, or it could be a hurricane, and that people should be prepared for getting worse because we've never, this war, quantitative tightening, fiscal stimulation, the tension between America and China, these are just very serious things that have, bad economic outcomes.
Well, speaking of bad economic outcomes, are you now penciling in the worst case scenario, given the fact that central bankers have no choice but to continue to tighten? And what we have seen at this point in time is further deterioration as far as Russia and Ukraine is concerned, and further tension between China and the US over Taiwan. Are you now bracing yourself for the worst outcome?
No, maybe you'll be surprised, but when I said in June, I expected all those things to happen. More inflation, higher rates. I talked about an unpredictable war. Wars are unpredictable. I still think the range of outcomes is a range, and you should look at it. I think a soft landing is probably a very small chance at this point, but mild recession, harder recession, they're all possible. And it's hard for me to give them odds, but they're all kind of possible. And remember, when I say get ready for it, I'm also talking to companies and investors, where my real point is we're prepared for it so we can serve our clients. we're going to be serving clients in India regardless of whether it's a hurricane or a mild storm. And that's why I think people should be prepared. I'm much more concerned, by the way, about the humanitarian crisis, the war. These are bad things. Volatile markets we can all deal with, but there are a lot of people who are being hurt by these conditions around the world.
Oh, absolutely. In fact, the sustainable development goals, nearly every single one of them, we are off track, and it looks like the 2030 timeline is unlikely to be met. But, let's talk about India, Jamie, and it would have been nice to have you in India. But what's the outlook on India at this point in time, especially given what's happening around us?
Now, look, I think it's very good. Since I've been coming to India, I've seen a nation that's grown dramatically over time. Like, we have 40,000 people there. It's the second biggest destination for technology for us. So it's very high tech. And so your education systems are excellent, a lot of things. But look, and you've done a lot of I've always done fabulous things like your biometric identification, opening checking accounts, trying to develop your infrastructure better, getting rid of bureaucratic regulatory burdens. It should be the fastest growing nation on the planet for the next 10 years. If you don't, it's because you didn't do all the right things. I think if you do those things, it's very bright. And you have people like America who want to be your ally and partner in many more ways. And then I think you have a little bit of a gift. This is not what I'm about to say is not anti-Chinese, but as every nation looks at, and every company looks at supply chains, they're going to have to diversify more. And a lot of people say China isn't as secure a supply chain and therefore have to move manufacturing to somewhere. And I think India could be a huge beneficiary of that. You got to make sure the rules are right, and the regulations are right, and the capital is treated right. And I talk about rules and regulations, I'm talking about rule of law, bankruptcy law, tax code. If you get those things right, the world is your oyster.
Well, we have a lot of that already in place. Of course, more work needs to be done, but a lot of those reforms have already been taken forward. But Jamie, one of the things that the market is going to be watching very closely for is the possibility of the inclusion of the Indian government bonds in the JP Morgan Global Bond Index. And, the expectation is that we could hear a decision on that front sometime between September and October. Would it be a legitimate ask to have India as part of the bond index?
No, absolutely. You should ask it. You should fight for it. And I can't get involved in that because research is independent. So by law, but if I was India, I absolutely want to be part of it. And if I didn't get in, I ask why. And then I try to accomplish those things, get in. And so I'm hopeful for you. And it is a sign of a country, coming, growing and becoming bigger and better well known. And once in indexes, the other thing it does for you, it's always out there. So you get a lot of foreign direct equity investment. This time you get also foreign direct credit investment.
Yeah, well, we are waiting for that decision. But, you talked about fund flows, Jamie, and I want to understand from you what the outlook is as far as fund flows are concerned into emerging markets like India, in light of the fact that we are now seeing the Fed hike and perhaps needing to hike even more aggressively. And what is the trajectory on rates that you are now working with?
Yeah. So, one of the things where I talk about those storm clouds is I said the one thing I could predict with certainty is volatility in the markets. And because you can't have all this turbulence, this is going to go on for a while, yet you don't know where rates are going to change. The dollar is very strong. America is still strong. Is it going to be a recession? What's the real effect of QT and getting rid of negative rates? Europe is probably going into recession. That creates huge amounts of volatility. And unfortunately, that kind of volatility, you look at emerging markets and the strong dollar, you have to go country by country. Some countries benefit from, don't get hurt as much from a strong dollar. Some benefit from it. Some sell commodities in dollars. Some buy a lot of oil in dollars. So it's literally country by country, what they borrowed, how much debt they have, and stuff like that. But it does cause a lot of turbulence in the flow of funds. Markets can get pretty fickle, particularly when you're investing in emerging markets, venture capital, things where small changes in assumptions can change the value of what you think something's worth quite a bit. So they should be braced for flow of funds that they don't particularly like. And the other thing about the dollar is that an economy which is outperforming other people relative to expectations will probably have a stronger currency. And America is still outperforming, I think, what most people kind of expect, and that may go on for a while. So the dollar may not strengthen, but I'm not sure you're going to see it weaken either.
Okay. Talked about fund flows. Let's talk about what's happening as far as the stock markets are concerned. The kind of correction that we have seen in the global markets, India has been relatively an outperformer in comparison. What's the outlook as far as global equities are concerned in light of the uncertainties that you spoke of?
Listen, bond prices affect stock prices and dramatically sometimes. And you've seen some of that. I think that interest rates may have to go up another leg, another 50, another 100 basis points. That will have an effect on stock prices. It'll have much more of an effect on growth stocks than value stocks. And less of an effect in India, because in India, even though you have a lot of growth stocks, your growth prospects are so good for so long, it's just going to have a different effect on people investing long-term money in India. But to give you a shocking kind of number, 1% interest rates, $1 a year is worth $100. At 10% interest rates, it's worth 6 or 7, it's worth $10. And at 10% interest rates, 65% of the value is in the first 10 years. At 1% interest rates, something like 6 or 7% of the value is the first 10 years. So anything that has cash flows way out here, are going to be diminished in value by rates. And think of, by the way, Bitcoin, gold, certain types of real estate, raw land, venture capital, growth stocks where they're putting a lot of cash in now and hoping to get profits down the road. So these rates adjust everything differently, but they will adjust the value of all things.
You spoke about Bitcoin, Jamie. Given the kind of volatility that we're seeing there, what do you make of it? I mean, you've always been a bit of a skeptic, but do you foresee a significant decline from the levels that we're already at?
Yeah, I wouldn't use the word a bit of a skeptic. I would say a total skeptic. But that's about a crypto token that you call a cryptocurrency that does nothing. We believe in blockchain, DeFi, ledgers, and some of these tokens that do something. So if a token can do something for you, like as part of a smart contract, or it gives you information on a timely basis you want, that's got value. I mean, we're one of the bigger users of blockchain. So, but what I'm pointing out is that, at higher rates, you have to carry the cost of it. It has no natural income from it, and therefore that will affect it.
Yeah. What impact is politics likely to have? You've got the midterm elections in the US. You've, of course, got the big political event in China. And, of course, the war continues, which is sort of causing instability across Europe at this point in time. How are you reading or looking at political developments and geopolitics and the impact and implications it will have on the economy?
Surprisingly, elections normally don't have a lot of impact on the economy that year. But I do think this kind of geopolitical stuff you see now is a sea change of assumptions on what happened. So after February 24th, I think that shattered the illusions of a lot of people that peace is at hand and that national security is kind of a given. And so geopolitics, it just elevated. And of course, Ukraine did a lot to hurt the relation between China and America. And so we now, the Western world, the democratic world, also has to think through what role it wants to play. How important to defend democracy in this world? How, are autocrats going to be allowed to get away with certain types of things? And, India's got to figure that out too, by the way. So I would love to see the Western world in a mature, humble kind of way, get together, work with each other, create national security for each other around food and energy and other types of trade things, keep the world safe with democracy. And I do think it's important. It doesn't have to be done against anybody. It should be done for ourselves. And it really should be done together. In terms of trade in the world, in terms of bilateral investment rights, opening up each other's countries. I think the world would be far better if we did that. We did it well. And I do think, nations are doing a bit of that. And I think President Biden has done a good job coalescing some of that, particularly around Ukraine.
Mm-hmm. I want to talk to you about digitization and the competitive landscape in light of what we are seeing from fintech companies. We're seeing that play out in India. Of course, fintech companies not making any money at this point in time. But how do you read this, and what does that mean as far as JP Morgan's own plans are concerned going forward?
Yeah, so we have tremendous competition, okay? Indian banks in India, German banks in Germany, obviously the big banks in the United States. Then we've got shadow banks, which are huge. They've taken over a big part of the mortgage business. They've taken over a big part of direct lending, leverage lending in the United States. They've taken part a big part of trading. You hear about the high frequency traders and payment for order flow. And then you have fintech. And fintech, you got to look at, it's a huge amount of investment in it. Some of them are already quite successful. PayPal, Square, Stripe, to name a few. Others are around the fringes, data and a whole bunch of other services. And they're good competition. They also have very little regulation relative to someone like us, so they have advantages. But a lot of them are unprofitable. They're not all going to make it. And obviously, we can spend a lot of money building great systems. I'm for competition. I would prefer to see more of a level playing field on regulations. And then, but the other thing you didn't mention is big tech. I mean, Apple now has P2P, buy now, pay later, credit scoring. They white label credit card and bank accounts through Goldman Sachs, and that's a bank. They don't have social requirements, legal requirements, the same AML requirements. They don't have capital requirements, registration requirements, transparency requirements. And at one point, maybe the regulators will eventually say, okay, if you do a product, the product should have a certain type of regulation. And but anyway, we're going to have all the competition. I'm very comfortable about JP Morgan, but it's going to be a lot of competition, and there are going to be a lot of winners and losers.
All right, so that's Jamie Dimon, one of the most influential bankers in the world, perhaps the most influential, and saying that, of course, it's a time of crisis and volatility, but for India as a destination, the outlook is still very, very appealing. With that, we're going to take a very quick break. Up next, we'll talk about what's buzzing in the commodity space. Manisha Gupta will be with us. Hi, welcome back to Trading Hour. Let's shift our focus now to the commodity space. Manisha joins in, and today the focus is on metals. Hi, Manisha.
Sumera, thank you so much for that. Well, there are 2 or 3 trends that are emerging into the space right now. One, we had already factored in a 75 basis point rate hike from US Fed, and is the reason you saw a lot of selling ahead of the actual event itself. So there is a bit of a relief rally actually that we are seeing in the industrial metals there. For gold prices, we've been trading within that range, 1650 on the lower side to 1675 on the higher side. And this is a 29-month lows, by the way, for the gold prices there. We have seen gold come off those highs of 2050 in the month of March to 1650 right now. So it has been a $400 of a decline as well, because of the kind of rate hikes that we have seen and the strength in US dollar index as well, which is trading at a 20-year highs. The reason that the gold prices also are holding is because we have had the Russian president saying that they're increasing troops in Ukraine, and there is a bit of a sentiment premium coming in from that conflict yet again, is the reason you have seen the prices hold around here. Same is the case with silver as well. We have seen prices decline by nearly 2% since the event yesterday. There is also a Citi report which says that the technical support now for gold stands at 1650, and if that level breaks, then 1600 on the lower side is also a possibility. But Citi also goes on to say that they are bullish in case of gold by the end of next year and from 2024 as well. For the base metal prices as well, we have seen some decline, but the reason you have seen gains come in for the Indian markets is because the Indian rupee has depreciated by nearly 50 to 60 paisa, and that is what is cushioning this decline that we are looking at in the international markets. Also, while the event has passed, but the US Fed clearly is way more hawkish going forward, and that is what could pressurize the global economic growth. We already have seen China continue to decline. There is an expectation of stimulus. All the industrial data that we have seen come in from China and various other countries has been on the weaker side. The Chinese real estate numbers have been on the weaker side as well, and that would continue to weigh on. The US home sales number data that came in yesterday also has seen a decline for a 7th straight month in the month of August. So there's a lot of numbers that could actually continue to weigh in case of metal prices. There also was a statement from Rio Tinto late last night saying that copper is set for a short-term weakness. They are looking at inflation concerns and supply chains issue as well. But Rio Tinto also says that as we move forward by 2025, excuse me, you would be looking at higher demand and lesser supply, and that would support copper prices, so much so that we could be looking at prices doubling. But for the near term, the pressure just may about continue. And not just about copper. If you look at aluminum, that's trading at a 17-month lows. Zinc prices are trading at a 2-month lows. You have iron ore prices, which are now trading at a 9-month lows as well. We have seen $100 per ton break here as well. The Chinese contagion in sense of property markets now seems to be spreading to state-backed developers as well. And when you look at the real estate, I'm so sorry for that. When you look at the property investment in the month of August, that has continued to decline too. So all the numbers that we're looking at are still on the weaker side. So metals as a sector, I mean, the kind of relief rally that we are seeing right now perhaps could get sold into. This is what the metal prices have done on a month-on-month basis. Very far and few on where you can see perhaps a positive there. But copper, iron ore, gold, all of that trading in the negative. And that's exactly the scene that we have seen come in for zinc, aluminum and iron ore as well. Nickel, the reason that you have seen a rise onto that one is because of the Russia concerns. 10% of global nickel comes in from Russia and there are concerns sourcing it is the only reason that one is trading in positive.
All right, all right, Manisha, thanks a lot for getting us that entire wrap on what's going on with the metal prices. With that, we're going to get into a short break. The market, by the way, is slipping once again. We're pretty much at the low point of the day. From the top of the session, we're down around 120 points. So it is a 130-point cut that we're seeing on the Nifty right now. The mid-cap index also at the low point of the day. The banks is the main sector which is underperforming today, and some of the big auto names which are holding up, the likes of Bajaj, Tata Motors, have also slipped over the past 20 minutes. So let's quickly get into a short break now. But when we come back, we'll discuss the market technicals. Himanshu Gupta of Globe Capital will be with us.
Welcome back. IT stocks should be on your radar today because Accenture, the global IT giant, will be reporting numbers. And it's not just the numbers, because this is the Q4 quarter for Accenture. So this quarter, they will give you a guidance for the next year. And this will be the first peek by any global IT company into next year's demand. So whether growth is slowing down, what they have to say about macros will be important, not just for Accenture, but it's a read-through for the entire Indian IT sector. So the Accenture's guidance for next year, are they signaling a significant slowdown, a little bit of a slowdown? That's going to be very, very crucial. So keep your eye out on Accenture tonight and what they have to say about the demand environment. But let's also invite Himanshu Gupta of Globe Capital now for a quick technical check on the markets. Himanshu, it's a tough day today. We've also seen a lot of volatility. How would you trade it?
Hi, good morning to you. Well, I think after a lot of resilience being shown by the Indian markets over the last couple of days, today I think it is looking like that the markets are finally on the verge of giving up, and we might enter into some short-term correction which might extend in both the indices as far as Nifty and Nifty Bank is concerned. On Nifty, I think from an intraday perspective, I think a fresh shot can be taken around 17,580, 17,600 zone with a stop loss above 17,650. And on the downside, 17,480, 17,500 kind of targets that can be expected. And more importantly, from a positional perspective, if Nifty, we see the closing of Nifty below 17,550, 500 zone, then I think in the days to come, we can actually slip lower towards 17,200, which is the next important support zone for this index. Nifty Bank, again, below 40,800, it has opened a fresh downside. And my sense is that we are moving towards 40,200 odd level, which remains the immediate area of support. So here also one can initiate shorts around 40,700, 750 zone, keep a stop loss above 40,900, and the targets close to 40,200 can be seen here as well.
Okay, Himanshu, what about individual stocks? Which ones are you looking to trade today?
Yeah, Somera, good morning to you as well. Well, both the stock trading ideas are on the short side. First one is a sell on BHEL. Fresh breakdown on the charts. After a brief consolidation, the stock has actually broken its immediate support zone. So here one can initiate short positions for a target of 55 and a stop loss above 60 can be placed in BHEL. Second one is a short on Hindalco. Here also we have seen some kind of distribution that has happened over the last few days, and today we have seen a fresh breakdown in this stock. So Hindalco is a short for a target of 395 and 390, and a stop loss above 411 can be placed here as well.
All right, Himanshu, thanks a lot for joining us and taking us through that quick check on the markets. We're going to get into a short break now, but before we do that, here is some great news for investors. You can now track US market action real time on Money Control. So just log on to Money Control's website or app, and you can stay informed about all that matters in global markets. Hi guys, welcome back. You're still tuned into Trading Hour, and let's now talk about our brand new series on the IT space. With several brokerage conferences in recent days, we've been getting a lot of comments coming through from key IT companies amid rising demand concerns across the sector. So Rima has moved over to the big wall. Rima, the company you're looking at today is TCS. So take us through what the management is telling analysts.
Thanks so much for that. So, when it comes to TCS, the big worry is its exposure to Europe. Because amongst all the large cap IT companies, TCS's exposure to Europe is the highest at nearly about 30% of its overall revenues. And we all know that there are fears of a deep recession in Europe. There is concern that it's going to impact growth for TCS in Europe, and perhaps next year's budgets could get impacted. In fact, even in the Q1 conference call, the TCS management, Rajesh Gopinathan, had called out that clients in Europe remain watchful. And here he said, and I quote, "Some clients, particularly in Europe, have expressed concerns about the macroeconomic fallout of the ongoing conflict there. But the predominant sense is that technology spending will be resilient. That said, given the macro level uncertainties, we remain very watchful." That's what the management said in Q1. What they're saying right now is that there is no slowdown in demand in Europe, but Europe looks more vulnerable when it comes to North America, and North America will be the driver. On margins, the company has guided that Q2 margins will be better than Q1. So there will be a sequential improvement in margins. Remember, Q1 margins were impacted by wage hike. They also maintain that the Q4 FY23 margins, they're called the exit margins, will be at 25%. So there is a significant improvement compared to the Q1 levels of 23.1%, and the management maintains that. They also said that attrition is stable on a month-on-month basis, even though it still remains above their comfort levels. On individual verticals and the demand outlook, the TCS management told CLSA the demand is stable in financial services, which is about 38% of their revenues. Retail is also stable at 17%, though it is seeing some softness in manufacturing, particularly in Europe, at about 10% of its overall revenues, and life sciences, which also contributes about 10% to their revenues. Back to you.
Rima, thanks very much for that. Let's take a quick break. Up next, we'll talk about the market fundamentals. Joining in will be Jyoti Vardhan Jaipuria, founder and managing director of Valentis Advisors.
Welcome back. You're still watching Trading Hour. Now, a big cue that you should track today, it's on your screen as well, is that the rupee has moved to a record low. It's extended losses. So we opened, below that 80 level, and now once again it's moved even further. So it's currently at around 80.7 to the dollar, 80.67 versus the dollar. So do keep your eye out on the currency. In fact, actually all Asian currencies have seen cuts of between 0.5% and 1% after this Fed decision. So let's talk about that big Fed decision that we got. The U.S. Federal Reserve raised benchmark interest rates by another 75 basis points and indicated that it will keep hiking well above the current levels. The central bank also took its federal funds rate to a range of 3 to 0.75%, which is the highest actually that we've seen all the way since 2008. So let's listen in to what Fed Chair Jerome Powell had to say.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage points, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage points, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025.
Okay, that is the big story, and we'll keep coming back to it. But let's also invite Jyoti Vardhan Jaipuria, the founder and managing director of Valentis Advisors, who joins it on the show now. Jyoti, thank you very much for joining in. The Indian markets have been extremely resilient up until now, but the macros do suggest that there are further challenges. Increasingly, most of the leading global companies are warning of profits hit on account of inflation, bleak global demand, and at some point, the economic reality of what's happening in US and Europe does filter and reflect, on what's happening in India. Do you think India's outperformance could get challenged? How would you assess the setup right now?
Yeah, so, Deepa, you're right. So to some extent, I was surprised with how resilient our market was. Like even today, the market didn't really fall as much as a lot of the Asian markets did. I think one reason for that is just, our domestic economy has been doing well and it continues to do well. If you look at like on a relative basis, probably India will be the fastest growing economy over the next, let's say, 3 to 5 years. And most people accept that globally also, that this is going to be the sweet spot in terms of economy. So that is helping the Indian market. At the same time, I think some of these global challenges are going to hurt us. We had a very stable current account deficit, which now will come a bit under pressure. We will have the currency coming under pressure. So there will be challenges. The export part of the economy will start to slow down. So to that extent, I think, we need to be a little cautious at these levels.
Hi, Mr. Jaipuria. Good morning. This is Pavitra. So you said that we need to be a little bit cautious at this level. What is the kind of risk that you pencil in on the downside?
So, Pavitra, the way we've been looking at the markets, and that's the way it's played out, is this is going to be the year of consolidation. So we'll be like, plus minus single digit for the year in terms of stock market returns. So far, it's working out in that respect. It's like, I think, practically flat for the year. And so probably a bit of downside, I think we could see. But otherwise, it's a market where over the next 6 months, I see it more consolidating. And a lot of the valuation correction probably will be time correction with a bit of a downward bias.
Hi, Jyoti Vardhan, morning. So a time like this would be the time to look for individual stocks, right? And therefore, how does one approach it? Do you start at the sector level and go down? And, where is your interest currently?
So, we've had one theme from the last many months, and that has been we like domestic India. We don't like things which are more exposed to the globe. So basically, whether it is software, whether it is global commodities, whether it is anything export related, we've been trying to avoid. We've been trying to buy a lot of stuff which are more domestic oriented. Some of the sectors which we've been positive on, one has been banks, which, basically we saw a cleanup for the last 3-4 years in the banking sector. So there was a sweet spot over the next 2 years where, NPL provisioning is going to be much lower. Second is credit growth is picking up, partly because of inflation, partly because the economy is starting to do well. And so, initially with rising interest rates, they have margins which go up initially, at least because, deposits reprice with a lag. So to that extent, banks has been one area we are clearly positive on. We continue to be positive. And so every dip which we get in this correction, we would be adding to the banking space. The other thing we've generally been looking at is global commodity prices had gone up a lot. We think global commodity prices are going to come down. So in that sense, any user of the global commodities which were getting hurt on margins will start to see better margins. So one sector is cement, which was hurt over the last 6-9 months. So that's one sector which we are playing. The other would be, building materials. So whether it's tiles, whether it's, cables, all of these will see strong domestic demand and margin improvement, which will come through.
What about IT? The street is still very divided because the valuations have come off. We've seen a significant amount of PED rating. It's been the worst performing sector. There are concerns about macros. But on the other hand, many people believe that the worst is still to come and things could go down south from here on. Which camp are you on?
So we've been avoiding Rima. We've been avoiding IT simply because, as the things start to deteriorate globally, it's very tough to figure how bad things can be. But what you can clearly see, and if you just go back to the Fed statement, yesterday, Powell was very clear. He said, I think we will get a recession, and he's okay with getting a bit of recession because he wants to kill all inflation expectation. So to that extent, global growth could, surprise us more on the downside rather than on the upside. Europe is, I think, a very, very weak spot. So both Europe and US could see economy starting to go down. And that's why I think, we could see, some pressure coming on margins, some pressure coming on top line, which we don't anticipate. The other thing is, if the US markets fall and Nasdaq falls, then basically a lot of these companies end up taking the cue from there in terms of valuation. So I think, that valuation could be the other area which could be disappointing. So even though they have fallen a lot, and so it's come on our radar simply because they underperform so much, we're still not overweighting the sector.
Okay, that is on IT. Another space that we have been discussing a lot is this entire defense pack and the kind of rally we've seen in a few of these names. There's this big government push on indigenization. Do you think there's a lot more left in this space?
Yeah, so, I think defense will be like a great theme for the next 4-5 years, simply because, the government is committed to buy more and more stuff from the domestic industry. And, so we're just scratching the surface at the moment. So, the number of plays we have are limited. There are some big companies which are get to defense, which are doing well, but then, defense accounts for like 10-15% of their order book. So there are some larger public sector companies which are there, and there are some smaller private sector companies. So we are very interested in the defense space. We are looking at it, we're buying it. I think obviously in terms of share price, there'll be some challenges along the way because a lot of these orders are lumpy, and we have seen a lot of share price movement already. But this is a sector where over the next 3 years, 5 years, we'll make a lot of money. It may not be in a straight line, and maybe some of these stocks need to consolidate short term.
Okay, defense is a space is attractive. IT is an avoid. Thank you, Jyoti, for joining in. But he's still cautious in the markets as a whole. Doesn't expect big returns. Perhaps some more consolidation, maybe single-digit kind of returns from here on. We'll get into a very short break on that note. We'll come back and focus on the currency space. The dollar index has hit a 20-year high. The rupee is weakened below 80. Some more details on that when we return. Welcome back. After a record low open of 80.28 against the dollar, the rupee has extended its losses, and I think it's currently hovering around 80.72 against the dollar. Lata is here with us, and she's going to tell us if the rupee will settle above these levels of 80 against the dollar. Lata?
Well, it's a seminal move that the Reserve Bank has allowed the rupee to cross the 80 barrier, as it were. Clearly, this has been forced by a very hawkish Fed, more hawkish than expected Fed. Up until Wednesday, the RBI had allowed depreciation but was ensuring that the rupee always closes under the 80 per dollar mark. But this let go is very important, and this could have been dictated by the fact that all Asian currencies today have depreciated between 0.5% and 1%, quite clearly because the Fed is telling us that it is going to hike 150 basis points more from current levels. The market was not prepared for so much. The specific move that may have moved the RBI could be the Chinese yuan. The Chinese yuan has actually depreciated lockstep with the dollar up until July, even in March. You needed 12 rupees to buy a yuan. By July, it had come to 11 rupees 80 paise to buy a yuan. Now the rupee had appreciated to 11.30 per yuan. And, we have the biggest trade deficit with China. It doesn't make any sense to not depreciate at least as much as the Chinese yuan, if not, depreciate versus the dollar. All this may have, entered the calculations, but the Reserve Bank is worried about the other side. A severe depreciation of the rupee will have its implications on inflation. Because imports become expensive. It will also mean a bit of financial instability. And if you have listened to previous governor speeches, more than inflation, they concentrate on financial instability. So guesses in the market are ranging between 80.50, 81, 82. We have to see where it settles.
All right, we'll wait by and see how the currency moves. Lata, thanks a lot for bringing us all of the details and the rupee move that we've seen all of this morning. But just a quick reminder, we were pointing out earlier as well that the fact that the rupee is weakening could really be a benefit to the entire textile sector, which does export. So we're going to ask a key company what they think and how much it could really impact their exports. We'll speak with the management of SP Apparels in just a bit on Halftime Report. So stay tuned. We're going to, discuss all of that with the management, and we will talk about that. But sticking with the rupee, despite it opening at a record low of 80.28 against the dollar today, it is seen to be the best performing currency as opposed to the ringgit, the yuan, and even the euro since February of this year. So in our special series, Fin Street, my colleague Abhishek explains how the rupee maintains this outperformance. Abhishek.
Let's focus on rupee, which is the best performing currency from Feb 2022 to now. This when compared to the likes of euro, ringgit or yuan. So forex reserves or foreign exchange reserves are the assets that are held by a nation's central bank or monetary authority. It is generally held in reserve currency, which is usually the dollar, and to a lesser degree to the euro, Japanese yen and pound sterling. So it is used to back the liabilities like the native currency being issued and also forex deposits which are deposited by financial institutions or the government with the central bank. So foreign exchange reserves are also a true barometer of central bank's reserve management to ensure that the central bank has control over adequate foreign assets to meet the nation's objectives. So the objectives may include providing a level of confidence to the market, backing the domestic currency, assisting the government to meet the forex needs as well as external debt obligations, while also maintaining a reserve for potential national disaster or emergencies to keep the value of the currency stable. And countries with a floating rate exchange use the system in terms of forex reserve to keep the value of their currency lower than the US dollar. Let's take a look into RBI and its bravado. So RBI has been managing the currency impact from the war between Russia and China or the current global macro situation that we are in. So India has seen a massive decline in its forex reserves over the last few months. In dollar terms, the forex reserves has declined by 12.8% from Feb 2022 to now. Value-wise, the forex reserve in India has declined from 632 billion US dollar that it was in Feb to now about 551 billion dollars as of 9 September 2022. The wonderful effect that this has had on rupee is the fact that rupee is the least depreciated currency. Rupee has depreciated only by 6.5% when compared to ringgit depreciating by 8.5% to the US dollar, or about close to 10% that yuan has seen the depreciation, and about 12.7% depreciation seen for euro versus the dollar from Feb to now. The impact of lower depreciation of rupee versus dollar is that lower currency depreciation helps in trying to curb the rise in inflation, as it helps in reducing the cost of imported goods and materials. It also has an impact on the availability of money for the government to spend, boost exports, as well as it can help to curb the trade deficit, and finally reduce sovereign debt burdens. Bottom line, exchange rate management helps in managing policy. Stronger currency relative to the rest of the world can actually boost imports, while it also aids in controlling inflation. So Indian rupee has been the best performing currency versus peers thanks to RBI's moves.
All right, Abhishek, thanks a lot for getting us that explainer. We are going to take a quick look at the market. It's 150 points lower on the Nifty, so we're back at the low point of the day. From the top of the session, it's around 140 points that we've lost, and it is really the banks which are looking the worst with a cut of 1.4%. So it's a red screen across the Indian markets, but with that, we're completely out of time on this edition of Trading Hour. Thanks a lot for tuning in. Halftime Report is up next.